Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and with me today is Justin Williams. Hey, Justin.
Hi, Matt. Thanks for having me as always.
Thanks for coming on the show. And I'm here to help you make the most of your minerals and royalties. And to that end, we're going to be covering relevant mineral rights news for December 2019 to help you think about your assets, and maybe some of the takeaways from these stories will apply to you, even though we're just talking about a couple of specific basins here. So, Justin, do you want to go ahead and dive into the first story?
Absolutely. Let's dive in. So the first story we have here is the underground way to earn a 10% yield in oil stocks. A group of companies are gobbling up mineral rights below oil and gas fields, consolidating a widely held and uniquely American asset class. There's yield bubbling up in the oil patch. A group of companies that is amassing mineral rights beneath oil fields is paying out enticing dividends with yields upwards of 10%, even as shares of the companies drilling the wells are having a miserable year. Mineral rights entitle these firms, including Viper Energy Partners LP and Kimball Royalty Partners LP, to the first cut of cash once oil and gas wells begin producing. The royalties they receive usually range from about 12 to 25%. Their place at the head of the line for payouts, plus the fact that they bear none of the drilling costs and keep collecting even if producers drill themselves bankrupt, have helped mineral owners outperform most other energy stocks in a year when investors' sentiment has collapsed due to the low oil and gas prices and proliferate spending. Some investors see those chunky yields, which exceed the roughly 1.8% payout offered by the S&P 500, as a sign the companies are undervalued. But to others, they signal risk in how closely tied those firms are to volatile oil and gas prices. Shares of the 24 exploration and production companies tracked by the Wall Street Journal have lost more than half their value in 2019. The SPDR S&P Oil and Gas Exploration and Production Exchange Traded Fund has lost 21% this year, even after accounting for dividends. Mineral companies have generally done better. Kimball is up 14%, including dividends. Brigham Minerals is off 1.8% since its April IPO. Viper is a spinoff of West Texas oil producer Diamondback Energy and is also down 1.8%. Mineral rights are a uniquely American asset class. In no other country are most mineral rights owned by ordinary citizens. It is also a highly fragmented asset class akin to rental houses. The National Association of Royalty Owners estimates that there are more than 12 million private owners of mineral rights. Kimball calculates the total market value of mineral rights at about $550 billion, of which public companies own just 2% or so. The principal way to acquire mineral rights has usually been to inherit them. Never sell your minerals is a marketplace adage. These days, though, that bit of country wisdom is being cast aside by many who have inherited the rights to oil and gas royalties. The result is a consolidation by Wall Street of assets that have long been an integral part of intergenerational family wealth. Analysts think gains will continue for the public companies aggregating mineral rights. Among 5 widely covered mineral stocks, 2 have unanimously buy ratings from analysis, according to the FactSet. The other 3 companies each have a signal hold grade, or else they too would carry unanimous buy recommendation. Of course, Kimball, Raymond Jones analyst John Freeman recently wrote, "The stock remains grossly undervalued." So this is interesting and something we've talked about before, Matt, but this is kind of something over the last 5 to 10 years that has just really grown. And I think most mineral right owners see those letters coming in from the mail from those firms and people wanting to purchase their assets.
Yeah, that's exactly right. And I think this is the beginning of the consolidation of minerals in some of these major basins. So what's happened over the years, as many of our listeners know, these get passed down through the generations, and then you have, whereas maybe one family owned the minerals, now you have, a dozen or more separate owners of those, and so they keep getting subdivided and diluted. And what's happening now is as they're getting consolidated, so as the family members go and look to sell, maybe they don't have the connection to the land like their ancestors had. They are wanting to cash out and not have to deal with the uncertainty associated with minerals. And so now these companies are coming in and buying them up, and now there's one owner again. So it's kind of interesting how it's come full circle in some cases. And I think one of the things that we'll see going forward is this will just continue. I think that there's a big appetite for dividend producing investment, and this is sort of a way to get that. And the dividend is effectively the royalty rate that you get from production. And interesting how some companies, like they mentioned, Diamondback Energy, they have Viper that's investing in minerals in the areas where Diamondback operates. And so the cool thing about that is that allows Viper to effectively have control over the timing of when wells get drilled. And normally that's not the case. Normally with minerals, you're sort of at the whim of the operator and when they want to go and drill the wells. And so there's a bit of additional risk from a time point of view as to when you're going to see your return on your investment. But that synergy between Viper and Diamondback, just as an example, is interesting because Diamondback can choose to go drill wells in a particular area, and Viper simultaneously can go in and gobble up the minerals there, and then get a more guaranteed rate of return based on the timing and when those wells are going to get drilled. So I thought that was kind of an interesting bit of information. We also talked a lot more in depth about just investing in mineral rights in general in episode 26 of the Mineral Rights Podcast. And we mentioned one of the ways to do that is to invest in some of these publicly traded pure play mineral companies. And, not to endorse any one specific company, but, I think if people are looking to invest in minerals, that's probably the best way for a, person to go to get into the business, basically, is to invest in some of these publicly traded companies that have the broader asset base, and they've diversified based on investing in minerals in maybe different basins across the country. And you don't have to have the technical knowledge to be able to evaluate properties on your own, and so you can leverage that through investing in some of these companies. So that's kind of an interesting bit.
Absolutely. And we'll dive into the next story here, which is not such a happy note. So landowners allege Anadarko monopolized oil and gas leases, and they fear major financial loss. Nearly 36 Wyoming landowners are suing Occidental Petroleum Corporation and its recently acquired company, Anadarko Petroleum Corporation, alleging that they monopolize both the oil and gas market and the leasing rights in Laramie County. Occidental Petroleum acquired Anadarko this year in a deal valued at $55 billion and is in the process of finalizing the sale. The lawsuit was filed November 25th in the U.S. District Court of Wyoming. Attorneys representing the landowners argue Anadarko has utilized its checkerboard leases along with horizontal drilling to take over thousands of acres and obtain over 2,000 drilling permits. According to these lawyers, Anadarko then set inflated prices for the land by selling it to its own subsidiaries, which in effect excludes competitors from producing. Anadarko has tied up all permits and permissible locations for wells in the relevant market. Other companies have refrained from seeking fair market leases of mineral rights from owners in even numbered parcels, including plaintiffs, the filing read. The landowner attorneys say the company has not drilled a well to produce oil or gas in Laramie County since 2013. It's never attempted to drill a 2-mile horizontal well in the county, and the company has no firm plans to drill wells in the county. They argue that Anadarko's intent to exclude competition and inflate value. Attorneys say the impact to landowners is serious. For one, the company's position allows them to force landowners into accepting below average royalty rates. So this is definitely interesting, Matt. And we were just talking before the show, there's a little bit of history to this that you could share.
Yeah, there's a bit of history with Anadarko, and they acquired those minerals when they purchased Union Pacific Resources. And as many may remember, the Union Pacific was one of the original railroad companies that got mineral rights as part of the Transcontinental Railroad when it was built back in the 1800s. And so they, from the government, one of the things they were able to retain was the minerals. And there's a checkerboard pattern along the right of way of the railroad where they own mineral rights, like the article mentions that alludes to, and it's in the odd sections along those along that right of way. And the interesting bit with Wyoming and the DJ Basin is, as the article mentioned, companies, and Anadarko in particular has really been leading the way here, but they really permitted the heck out of the acreage in the southern Laramie County bordering Colorado. And so what they did is, like they mentioned, they got over 2,000 drilling permits and then just basically sat on them. So they established a foothold, and there isn't the incentive there for them to go and drill the wells in any sort of time frame, other than needing to renew permits, which is not a terribly cumbersome process in Wyoming. I think there was some state regulations that were proposed that were going to help provide an incentive for companies when they permitted wells to drill them in a certain period of time. I'm not sure where that ended up, but that would be, I think, good from a landowner perspective, as it would help them to basically, drill that acreage. Of course, if leases aren't drilled, as many people know, once that primary term expires, then the lease doesn't, as long as it's not renewed, it gets released, and so you could then potentially release that acreage to another operator. But again, like the article mentioned, companies have just sort of stayed away from that area because Anadarko had sort of a monopoly on the land position there. So hopefully this gets resolved, and there is incentive for companies to go in and actually drill wells in Laramie County. I think one of the things helping that is the regulations that are being passed in Colorado. It's going to make it more cumbersome for operators to drill wells on the Colorado side of the DJ Basin, and so some may look to Wyoming potentially to go and invest money because there's less political risk. And we've talked about this in the past in the episode where we talk about the DJ Basin as a whole and kind of the overview. But yeah, I thought that was kind of an interesting story, and a related story as well. Oxy is actually selling their DJ Basin position, so they're offering about 200,000 acres in the basin in both Wyoming and Colorado as part of its asset sales to reduce the debt load of around 40 billion that they used to pay for the Anadarko acquisition. And so, the interesting part of this asset sale is it does include the significant mineral rights portfolio that Anadarko held through UPR. And so, anyway, that it'd be interesting to see how this plays out. Who ends up buying the Oxy DJ Basin assets, and then what are they going to do with that going forward? And word on the street is that Oxy expects the sale to bring in about $700 million. So, but hopefully they'll get off a high center and start on some wells in Laramie County. All right. So the last article that we have for this month is also talking about the DJ Basin, but it really applies to anywhere in the U.S. So the article says, drilling, dollars, and debt. Colorado's oil and gas industry is leveraged to the hilt. What does this mean for the future? Producers are still doing a robust business, but to keep up, they've had to borrow. And with fewer willing investors and declining prices, that business model is being put to the test. A new and more severe ruler is on the throne in the oil and gas industry, and the state's petroleum producers are bending the knee and doing their best to survive. After years of handing shale producers fistfuls of money to grow production as rapidly as possible, Wall Street is demanding they operate more efficiently and cover their costs without heavy borrowing. Basically, investors want producers to shift from spending more than they make and using debt to fill the gap to generating surplus cash and providing them a return. Free cash flow is king, Jennifer Martin Samuels, vice president of investor relations at Denver-based SM Energy, declared this summer at the Energy Summit, an annual industry gathering. The state's petroleum industry employs about 90,000 people directly and indirectly, generates $13.5 billion in economic activity, and provides $1 billion in taxes to state and local governments, according to an analysis from the University of Colorado Boulder. The industry's ability to achieve free cash flow is vital to the state economy, not to mention winning back the investors burned by years of underperformance. And yet, the 8 largest public producers active in Colorado have spent $27 billion more than they've made in the past 5 years, according to financial numbers. And this article goes on, and it's a really in-depth article. Highly recommend if you have minerals in the DJ, check it out. We'll have links in the show notes. But the article goes on to say that wells drilled in shale formations are different than conventional wells in that they offer a huge payout early and decline rapidly by as much as 65% to after the first year. Production eventually steadies, but at much lower levels. That early surge is good at generating cash flow up front and in taking advantage of higher prices. But it also means that producers have to keep drilling or face a big drop off in production. One analogy that describes the situation is running on a treadmill, said Raul LeBlanc, Vice President of North American Unconventionals at IHS Markit. Unconventionals are wells drilled in shale formations, and they are driving the latest boom in U.S. production. When producers ramp up production, as they did in 2017 and 2018, the treadmill speeds up. Last year, onshore producers in the U.S. had to add 2.6 million barrels a day in new production to stay ahead of production declines. They added 4.5 million, allowing output to grow. But all that new drilling meant 3.5 million barrels a day needed to be replaced this year, LeBlanc said. IHS Markit forecasts that spending for new onshore production in the U.S. will fall from $102 billion this year to around $90 billion next year, and then $83 billion in 2021. And it says, effectively, the shale boom is over. Long live cash flow. And like I mentioned at the beginning of this article, this one talks specifically about the DJ Basin, but the same concepts can be applied to any unconventionals basin in the U.S. And I agree 100% with the author that cash flow is king now. Companies that figure this out will still be in business a couple of years from now. Those that don't will end up going bankrupt and will get gobbled up by their competitors. And so I think what this means for oil production in the U.S. is that, barring a modest increase in oil prices, we may have seen the actual peak in oil production from these shale plays. Again, because of these steep decline rates of these wells, you need to keep drilling in order to replace the decline in production from existing wells. And so, interesting, Justin. I think that potentially highlighting what's to come here, again, with respect to companies that figure this out, they'll be alive here a couple of years from now. Those that don't get a handle on their cash flow are going to be out of business.
Absolutely, and I completely agree. And this is something we had mentioned, I think, before in the news, that this was something that was going to be coming. The ones that the strong companies will outlive it. The weak companies will end up getting gobbled up and consolidated, which in the end of the day is good for the market.
Yeah, but I think the takeaway here for mineral owners is, if you do own minerals in the U.S., then and you don't have acreage that has been fully developed, it may be a lot longer before you see royalties coming in, because companies are going to space out those investments over a longer period of time. And as a result, they're not going to drill as many wells per year. And so if you just happen to be lucky and in a spot where they are going to move to next, then that obviously may not apply. But for most, I think what it's going to mean is a delay, and it's actually seeing royalty payments from these wells that would potentially get drilled on your acreage in these shale basins. So maybe not such a great story from that standpoint, but I think on the bright side, the companies that do figure this out and are going to be in it for the long game, it's just a matter of time. And so if you're patient, you'll see that return. But and interesting in the next 2 years, really, I think, to see what oil price is going to do, and then what shale producers are going to do as a result. I don't think, if we're to see some major geopolitical issue and price were to spike, I would expect that shale producers would be a little more measured in ramping up production this time. And I would hope so, that otherwise what you'd see is oil prices just tanking because of that oversupply situation we get into again. But it's going to be a curious next 12 months or so.
Absolutely. And like we were talking about a bit before, it has a lot to do too with the lenders and how comfortable that they are feeling. Oil and gas is such a capital heavy business, that they really need those banks and the lines of credit to be able to continue drilling and be able to sustain the cost involved with that.
No, you're absolutely right, and I think a lot of these companies that do have these maybe have overextended themselves. They're going to look at needing to pay back that debt, and if they don't have the free cash flow to do so, they're going to end up going out of business. So yeah, interesting to see what happens.
I think that's a pretty good wrap for December, Matt.
It is. And, happy holidays to everybody that is listening. And we'll come back with another news episode in January. Be sure to subscribe so you don't miss the next episodes that come out. So definitely subscribe. And then also, if you're going to do that while you're at iTunes, please leave a rating and review. It helps us reach everyone that needs to hear this information. And we appreciate it very much. So thanks again, and we'll talk to you next time.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.